What's up YouTube, and welcome back to another lesson from the High Performance Trader. And today in this video I am going to break down the main reason why 95% of day traders fail. See, it's not because they're stupid, it's not because they're incompetent, it's not because they're lazy, right? It's because they do not have a clear, well-defined approach that keeps them away from taking bad setups. I struggled to become a day trader for many years. It was around 4.5 years it took me to become profitable, right? And once again, it wasn't because I was stupid, right? It wasn't because I was lazy, well, maybe a little lazy, right? But the main reason was I wasn't clear. I didn't have a clear approach. I didn't have clear criteria that was back tested and understood on a statistical basis. Therefore, I would show up to the market each and every single day making irrational decisions that led to inconsistent profitability. So today in this video, I want to show you what my criteria is, what it is I look for, right? What defines my edge, and why it's so important to have this criteria and why it keeps most traders in the rut. Right? So before you are going to see, this is the trade that we took on 12/6/2024, and at this point, I'm entered the market short, right? So what led us to this point, right? Josh, why didn't you long the market up here? Why didn't you long off previous day high? What kept you this patient, this focused, this disciplined, and what actually made you pull that trigger? Well, that is what we are going to discuss today in this video, right? So it's a 3-step process, right? Number 1 is identify your critical levels. These are your pit numbers, right? And a lot of traders aren't aware of what a pit number is, so let's break it down real quick. A pit number derives from a daily time frame candle. There are 4 main pit numbers: previous day high, previous day low, previous day open print, and previous day close. These are 4 main critical levels. They're important because they have massive amounts of volume. Okay, that's step number 1. Identify your pit numbers, right? So before you're going to see we have previous day low right here. We have end of day. We have previous day open print, which is this blue line right here. And then we have previous day high. So going into every single day, I have these levels mapped out. It is non-negotiable, it is extremely important, and it leads me to my first principle. We do not move the market, the banks do. So it's not up to us to predict what's going to happen, it's up to us to identify objectively what is happening at these levels. Why? Because these levels hold the volume. The volume is large money, smart money, whatever you want to call it. We have to identify what they're doing, right? So number 1, identify your critical level. Number 2, is identify a large money taking control of the critical level, right? This is done through using market structure and moving averages, right? Josh, what does this mean? This means as price is rallying to a critical level, like here at previous day high, it's now up to me to identify who's taking control. I do this through moving averages. Everybody knows I use the 5 EMA, the 21 EMA, which makes up my EMA cloud, right? So I'm going to pull that out right here. And then I use the 9D EMA, that's a double exponential moving average, that's that blue line that you see, right? So these are my 3 main moving averages in the 50, right? So that's the 9 DEMA, the 5 and the 21 EMA, and the 50 EMA, right? These are very important, and it's not because it's the 9 or it's the 50, it's because I've studied what healthy price action is supposed to look like off these moving averages. We don't trade extensions, right? We don't trade erratic price action, right? We stay extremely patient. We're looking for healthy criteria off these critical levels, and we do that using the moving averages, right? So price was very extended from the 50 up here. I do not want to long the market when I'm that extended. Instead, I want price to come a little bit closer back to the 50. Now, this leads me to my next principle, where you must accept the fact that you may miss out on some trades. Josh, you missed the morning setup. So what? I don't care. It's not my job to hit every single trade. On the contrary, it's my job to remain extremely patient and execute perfectly when I do see my criteria, right? So once again, it's very important, guys, acceptance. You have to accept the fact that you're probably going to miss setups, and that's okay, right? Go talk to any successful trader. Look at their journal. Some traders take 5 trades a week, 6 trades a week, right? Very, very minimal. But when they see their edge, they're acting. That is the trader you want to become, right? So now to my next and final step to my 3-step criteria. Number 1 is your pit numbers. Number 2 is your moving averages. Number 3 is your entry criteria. This is your green bar ignored. This is your red bar ignored entries. Now, a lot of traders ask me, which time frame do you use this on? And for the most part, I'm trading off the 5-minute and the 2-minute. There is no perfect time frame. To trade in and out of the market, you have to be adaptable. And more importantly, you have to understand the story, right? Therefore, there's no perfect time frame. I love the 2-minute. I love the 5-minute, right? You could use the 3-minute for all I care, right? The goal is to get you guys to a confident standpoint where you're able to understand what the market's telling you. The market communicates to us via price action, right? So we must use our indicators. These are our moving averages. These are our pint numbers to understand the story she's telling us, right? So let's break down the story. Price is rallying above previous day open print. Look at this red bar right here that gets completely ignored. This would have been a great long trade, right? Once we blew the top off this red candle, that would have been a great spot to take the market long. I was driving. I just got my daughter to school. I was not able to long that trade. Therefore, instead of getting frustrated, instead of going, oh, I missed that first setup, but I don't want to miss any more, and just chasing the trend, I say, hey, listen, I'm going to remain patient. And if price comes back to this red bar that was ignored, I'm then going to watch and identify who is in control. Is it buyers or is it sellers? Right? So price rallies off the pit number, comes back, tags it, and you can see buyers are showing up here, right? But look at the sellers that just continuously showed up every time we hit this 6,100 level, right? Real psychological level, right? Selling, 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 selling. And then right here on this candle right here, we actually broke previous day high, right? So this is the beginning of weakness, right? The trend is no longer, how do I say this? Healthy, right? It's been tainted a little bit, right? Sellers push price below a little bit. Doesn't initially mean that sellers are going to take control, but this is not any trade. This isn't what I like to trade. Therefore, I make no move, accepting the fact that I might just miss another long opportunity. And I hope you guys are understanding what I'm laying on here. It's all about acceptance. You need to accept the fact that you might miss a setup, and that is okay, right? So price then comes up and falls below. Now this green bar was completely ignored. This is the beginning of a bearish trend. We just don't know it yet. And then we get very large selling that comes into the market, and bingo, we get our moving average cross. Right? So that is a vital role in our process, is the moving average cross. We're getting the 5 and the 21-day EMA crossing, right? We don't just enter the market short right here because we got the cross. Instead, we're going to allow price to come back up to our level of interest. What's our level of interest? The RBI, the red bar that was completely ignored earlier. We are now going to wait for price to come back into this level. And if I smell a little bit of selling here and get the right criteria, I just may enter the market short. Right? So if I whip out the 2-minute here, you're going to see, look how price rallies into this level, and we get this nasty red candle right here, completely annihilating buyers, right? Red candle comes in. At this point, I am in the market short, and I'm now targeting open print. So let's go back to the Discord here, and you're going to see, where is it? At 11:46 a.m., I'm in the market short, stop above previous day high, and now we're starting to get our selling, right? And this is when I started to bump my stop loss down. Notice here, my stop is above the previous RBI. Once again, basing my whole trading setup off the pint number, the red bar that was ignored, and the moving average cross, right? This is how we identify it. Then you start to see here, we started to get some very nice selling coming into the market. We're closing below the 50 EMA, right? This is exactly what I was looking for, right? So now price is selling, and we're getting that nice move. We fall below previous day open print, and we come up for that retest. Price begins to sell off, and we go all the way down to open print, right? So guys, I apologize, my girl is blowing me up, but this is our beautiful 3-step criteria, right? Number 1, identify the pit number. Number 2, identify the healthy moving average relationship. And number 3, your red bar and green bar ignored entry. If you guys want to join my team, click the links below. I love all of you, and I'll see you in the next lesson.